Hey Bowtie Nation, Joseph Hogue here with a huge day for shares of Super Microcomputer, ticker SMCI, and what looks to be a confirmation of what we've been talking about here on the channel since late last year. The thing is, the great thing about the news last night is that it left just enough uncertainty, just enough red meat for the bears, that there is still time to buy more shares of this before it runs higher, high enough to my $83 price target, 115% return from here. A nation like Palantir was last year, like Nvidia the year before, SMCI will be the wish you bought sooner stock of 2025. Shares were already up 108% from our mid-November update, just after SMCI bottomed around $17 a share, and are up 49% in the last week after announcing their business update news released last night. And the market is liking what it's seeing, with their shares up about 7% after hours, again past $40 a share. And here you see, even on yesterday's 9% pullback, SMCI is my biggest investment, with over 19,000 shares and up over $211,000 from last year. I started buying in mid-September and then built that position through the November crash for a 39% return so far. But if this goes to my $83 price target, that is another $865,000 upside. This will be my $1 million stock. I'll go through that business update, what it changes, and my new price target. But again, this stock is going to keep on giving. It's like the proverb, the best time to plant a tree was 20 years ago, the second best time is now. The best time to invest in SMCI was back in November, but you still have a chance, and I'm going to show you a couple of option strategies along with that price target to boost your return. I want to go through last night's news, why it was so good for investors, but still leaves just enough uncertainty that gives you a chance to buy in if you haven't already. This was the company's second quarter 2025 earnings, so while other companies are reporting their fourth quarter 2024 earnings, not all companies report on that same schedule. Supermicro's fiscal year is from July of each year, so the October through December period is its second quarter. You're also going to notice that everything says management expects to report, and that's because SMCI is still finalizing its financial reports and having them audited here, so it's still using that expects language. But the second quarter results are a done deal. Management reports sales for the quarter will be between $5.6 billion to $5.7 billion, and what's important here, folks, when you're looking at any of these earnings reports is to compare them with what Wall Street was expecting. So how well did management hit those expectations? Here we see revenue estimates for the December quarter among 9 analysts were for $5.77 billion, with a low around $5.5 billion to a high of $5.9 billion. So that midpoint of $5.65 billion did miss those expectations. And normally that would be enough to send a stock crashing lower, but it was still 54% revenue growth, which is exceptional. And as we're going to see, management gave investors enough to be optimistic about with these other news. SMCI also reported that the gross margin would be in the range of 11.8 to 11.9%. This is important because it's been a worry for investors lately. Gross margin is the profitability in sales after paying suppliers and production costs. So the revenue minus some of those core business costs. And you see, it's been trending down since 2023. Now that has worried investors that the company is losing control of its costs. So that even on a very strong sales growth, it might still lose money. Now you see that margin fell to as low as 11.3% in the fourth quarter of last year, so a rebound to 11.8% margin would be a great start. We've also got here an estimate for the non-GAAP net income or adjusted earnings between 58 cents to 60 cents per share, which again was disappointing in that it was below the average forecast for 61 cents per share earnings, but 2 points is why it's really not hurting the shares much. Now first, because if we look at the company's earnings history, SMCI missed its earnings expectations by a whopping 23% in the June quarter of last year, so a miss of just about 2% here is very welcome. Also though, honestly, investors just aren't worried too much about these earnings for these AI-related stocks. Any company that can grow sales by 54% a year is going to grow those earnings and eventually become a cash flow machine. SMCI also reported $1.4 billion in cash and debt of $1.9 billion, which is a cash burn from the $1.68 billion in cash last quarter, though also a lower debt from just under $2.2 billion. And while some analysts have worried about the company's cash needs and its inventory, it's not a big issue, and management also reported a new $700 million convertible note issued to manage those liquidity needs. SMCI management also guided to its next quarter with sales between $5 to $6 billion for the third quarter, which again, unfortunately was below expectations for about $6.1 billion according to analysts. So last quarter and current, there does seem to be some fact to the rumors that SMCI sales were hurt on that uncertainty that some of their customers may have deferred to Dell or HPE for those servers. But again, the bigger picture is still very good. Management guided to full year 2025 sales between $23.5 billion to $25 billion. Again, disappointing that it's nearly $4 billion under management's own prior guidance, what they had said they would reach previously. It shows some of that weakness, but it also understand that would still be 62% revenue growth over the year. We're going to get to the big news next, but what really blew my mind here was two comments by founder and CEO Charles Liang, saying first that over 30% of new data centers were expected to adopt the company's leading direct liquid cooling technology over the next 12 months. Now, understand the scale here, folks, and you see how giant that would be. The big data center hyperscalers like Meta and Amazon have reaffirmed their spending plans after that DeepSeek news. And JP Morgan estimates that just these 5 hyperscalers, those big tech companies, Amazon, Apple, Meta, Google, and Microsoft, could spend upwards of $1 trillion in AI and data center spending through 2027. SMCI is the leader in data center server solutions and really the only pure play, so a 30% market share would take the company beyond its $50 billion revenue path. Just as surprising though, Liang also said that with the strong foundation set now, the company is paving its way to $40 billion in revenue for 2026. $40 billion in sales. That would be another 65% revenue growth. And while it is definitely possible SMCI gets there, I'm going to use that near-term revenue in our price target to show you that even this year's sales could mean another 115% return on the stock. The big news though, the news every investor was waiting for, was whether the company would meet the Nasdaq's February 25th deadline to file its late financial reports and stay listed on the exchange. I'm going to link to our November SMCI update on how we got to this point, including a complete analysis of the allegations by short seller Hindenburg, a firm that has since been closed down. But management did say in this press release that it is working towards those filings and believes it will make those filings by February 25th. Now, it also highlighted that no previously filed financial statements would have to be changed, but that it made some adjustments to the fiscal year 2024 statements. But it also seemed to confirm the prior release from its audit committee that found no accounting manipulations. Now, that belief that the company is going to meet its February 25th deadline wasn't exactly what investors were hoping for. SMCI and its new auditor have had since mid-November to get those reports done, and it's just 13 days from the deadline, so cutting it extremely close. Now, the confirmation that nothing was materially wrong with those prior financials and that a filing is coming was enough to take some of that uncertainty off the table, and that's why the shares are up after the report. The quarterly results were a little disappointing, though still showed amazing growth. Profitability is improving, but it's clear that the short seller allegations did hurt those sales a little bit. But here, for new investors, or those of you still wishing you had bought more of this could be the perfect report. And that's because while management confirmed that the company is still producing amazing growth and dominating its industry, there's still enough uncertainty in these shares around that filing deadline, and the stock is trading for a huge discount to its fair value. I'm going to reveal my price target for shares of SMCI and 2 option strategies I'm using next. Make sure you check out the video in the corner next for 3 more option strategies perfect for this stock. I start the video out with the basics of options investing for beginners, but then walk you through those 3 strategies, so look for that link I'll leave in the description below. I'll show you in my price target how shares of SMCI have an easy 115% upside, but I also want to highlight 2 other ways to play this, 2 option strategies that are going to boost your return and lower your risk in this stock. I want to get to our price target, so I won't go into the basics of options here. Make sure you watch that video next if you haven't used options before. And first up, we're looking at the February 28th call options here, which expire after that Nasdaq deadline on the 25th. So if the company does file on time, these options would give you exposure to that. Now, if that happens, this stock is going to surge higher, well past the $50 each, but buying these $50 call options here for $2.42 each means you lock in that price for the shares no matter how high they go. If SMCI rises to $60 from now until the option expiration on the 28th, that call option is going to be worth at least $10 each for a 313% return. And here's an options investment for those of you that want a little less risk, the covered call strategy. This is where you buy the stock, but then also sell to another investor those call options that give them the right to buy them for a set price. Now, the beauty of this, it lowers your cost per share and the risk that you have in the stock, but also gives you a great upside return potential. For example, using the January 2026 call options, buying the stock at $38.61 per share and then selling those $55 call options for $9.35 each, your actual cost is just $29.26 a share. That means you're getting a 24% discount to the current price and still have that upside to $55 a share. So if the shares go to that price by options expiration next January, which I think they will, then you're going to have made 88% return on your money with much less risk than buying the shares outright. And I know options investing and all the jargon is about as clear as mud if you haven't used it before, so check out the video for the basics and then those 3 other strategies. Even without using options though, there is still a strong upside to this stock. In fact, 115% upside to my price target for just this year. Now I'm going to use the revenue-based valuation here because it's the simplest way to value a stock and less prone to the errors or the assumptions for earnings or long-term valuations. Here we have management's new 2025 revenue guidance between $23.5 to $25 billion, down from its prior guidance, which is very disappointing, but still a very respectable 62% increase from last year. And with just 2 quarters left in the fiscal year, we can assume that they're going to hit that number around $24.3 billion midpoint. Now, of course, with CEO Liang's comment that the company is paving the way for $40 billion in revenue in 2026, that would be outstanding. But to be conservative here, I want to use this year's revenue. On the current market cap of $22.6 billion, the value of all the shares in the market here, and on that forecast of $24.3 billion in this year's revenue, we get a price to sales valuation of 0.93 times. And that means investors are paying just 93 cents for every dollar in sales generated by the company. And again, why I like using this price to sales valuation versus maybe the more popular price to earnings or PE ratio is that the price to sales is just as simple, but also not as susceptible to the kind of earnings manipulation or the accounting tricks that all companies use. And you're not basing your price target off some long-term assumptions and growth. Here we can see a short valuation history, and while the stock has traded as low as 0.4 times sales around the delisting back in 2017, we see a recent trend to valuation around 2 times sales. Now, a couple things to consider here when you're thinking about this valuation and what's a fair price for shares of SMCI. First is with that delisting thread or the claims of accounting manipulation largely off the table, we know the fair price is well above that 0.8 times price to sales where it's been trading at over the last few months. With those lingering doubts and the uncertainty, it's probably not going to trade at that 6 times price to sales where it was at the peak in March, but any stock growing sales by 60% a year and leading in the biggest growth trend of the market should be trading well above 1 times price to sales. In fact, I'd challenge you to find any other stock with growth of even 30 or 40% a year trading so cheaply. But here, even if SMCI just returns to that 2 times price to sales valuation closer to where it should be, and it will if management files those late reports by the 25th as they said they will, that's going to put more of that uncertainty behind it, and 2 times the forecast of $24.3 billion in sales gives us a fair value market cap of $48.6 billion. An upside of 115% from here, and a target of $83 per share. And Nation, I truly believe that could still drastically undervalue this stock. I want to be conservative here and show you that how even this near-term target makes the stock a buy, but hitting anywhere near that $40 billion in 2026 sales that CEO Liang thinks is in reach, that means another 64% upside from there, and probably more as investors start paying more on that price to sales valuation. Now, we used a conservative 2x price to sales for our target, but if investors come flooding back, paying 3 times price to sales, which is still half of what they were paying last year, that 3 times sales of $40 billion is a $120 billion market cap, a full 530% upside from here, and $200 per share for SMCI. Get a $150 discount on our options investing course and see how to boost even these returns with 29 option strategies with the special coupon code in the description link below. Or click on the video to the right for those 3 options investing strategies perfect for SMCI. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.